Hi, my name is Sandeep Patodia. I am portfolio manager for Indian equities in the J.P. Morgan team. I've been working here for the last 2 years. In fact, I just got back from India having met corporates there, and it was very interesting. I just want to go into and try and explain to you why India is a good investment destination. Maybe I'll start by saying that Indian economy has seen a structural improvement on the back of stable political environment since 2014, implementation of business-friendly economic reforms, and inflow of foreign capital over the last 10 years, which is driving sustained and high growth. This is unique for a country of India's size. What's really interesting is that the drivers of the economic growth are evolving and broadening from the traditional sectors of financial services, staples, and IT services, which were the most value creating sectors, I would say, over the last 20 years. But this is now broadening into other sectors like fixed asset creation, consumer discretionary, and disruptive business models. For example, we are seeing industrial businesses growing at a much faster pace and seeing tailwinds in specific subsectors like power and real estate. Discretionary consumption of premium vehicles and travel, for example, is seeing a structural up move with the population now earning a lot more at the top of the pyramid. And I would say lastly, and most excitingly, the disruptive business models are starting to take shape. The animal spirits are really coming back. You're seeing new business models like quick commerce, which is unique to the country, or an insurance marketplace, which are catering to the local needs and being conscious of the cultural needs of the country, seeing an emergence. Now, this excitingly gives much more legs to the economic growth to the Indian economy via blue-collar job creation, which has been lagging for a while. The wealth effect of GDP per capita, which is driving much higher consumption, and localized innovation, leading to better productivity and formalization of the economy. Now, you might want to ask and say, all of this is good, but why would someone invest in Indian equities? Would they generate value? I mean, Indian companies rank second only to the US in terms of their ability to consistently generate a very high ROE, or return on equity to be specific, of 16 to 20%. ROE is probably the most important metric that one looks for in terms of value creation. And now this ROE is significantly above the cost of capital and much higher than other countries like Japan, China, and Korea. What this ensures is that the growth is not just for growth's sake, it is a value creating growth, which makes in India an attractive investment market. Now, how do we test that? We test that by seeing that India's GDP growth actually translates into corporate profits and therefore equity returns. And we see that when you compare the stock market returns of Indian equity markets, it's only again second to the US, where this is translated into superior stock market returns. And therefore it makes India a very high quality equity market for investors. On top of this, the market is starting to become much more deeper and vibrant, with participation increasing from domestic investors because of the saving pools coming through, many more emerging markets investors and international investors getting attracted to it. And as a result, we've seen the weight of the Indian index going up, or the India in the index going up over the last few years significantly. Now, all of this is good. One would say, why active investment? And can active investment add value? Now, India is a market where corporate skill is appropriately rewarded by investors, making it a very good hunting ground for active investors. This is because management inputs usually takes time to translate into outputs in terms of superior returns or economic or growth that the company delivers. Some of the examples to bring this to light are like if you see the change of management, like when Sandeep Bakshi took over ICICI Bank, or when Tata Motors changed its game, or higher returns from superior incremental capital allocation in companies like Zomato and CG Power. All of these examples where management alpha translated into huge returns for investors. Unlike most emerging market countries, India is not dominated by one or two sectors and provides investors to choose companies from a diverse set of sectors. In addition, the small and mid-cap segment in the market is very attractive because it's growing at a fast pace. And many companies are IPOing at the same time in the country because the supply of money is coming through. However, I would say one word of caution is important to make sure that the liquidity is appropriately managed, and therefore bottom-up stop selection becomes crucial. Now, given these developments in the economy and new growth drivers emerging, it gives active investors an opportunity to showcase their investing skill. I hope this gives you a good understanding of why India is such an attractive market, why it generates huge value for investors over the long term, and active investment can add value. Thank you for listening.